A falling trend, massive insider sell signals, yet a sudden double-digit surge today.
Right.
So you have to ask yourself, is this stock severely undervalued, or are you looking at the ultimate value trap?
It is a wild setup.
Welcome to the deep dive. We are sifting through a mountain of data today on Hims and Hers Health, ticker symbol HIMS. It's April 16th, 2026, and we're unpacking all these wildly conflicting signals to help you figure out what's actually driving the tape.
Yeah, there's a lot to unpack.
Oh, absolutely. But real quick, before we tear into these numbers, please remember to like the video, subscribe to our YouTube channel, and, definitely leave your feedback in the comments. We need to hear your take on this because it's highly debatable.
Highly debatable is an understatement.
Right. And just as a disclaimer, we are strictly analyzing data for educational purposes today. We'll debate the bull and bear cases, but none of this is financial advice.
No, definitely not. But our mission today is really to synthesize this wild price action. We want to take these conflicting analyst signals and the underlying financials and just, map out exactly what is happening under the hood.
Because to understand if this is a trap or a real turnaround, we first have to look at what literally just happened today. The market reaction was violent.
It really was.
Yeah. HIMS closed at $26.99 today, surging 11.12%. I mean, an 11% jump in a single session is huge.
It's massive. And it doesn't happen without a major catalyst.
Exactly. So what was the why here?
Well, it was a positive regulatory outlook. The FDA came out with an update regarding compounded peptide therapies.
Yeah.
And since HIMS relies so heavily on those compounded formulations for their weight loss drugs, the market basically breathed this huge collective sigh of relief.
Right. Algorithms and institutional buyers just flooded the second that headline hit. But okay, let's unpack this a bit more because you really need the context of the 52-week whiplash the stock has been through.
Oh yeah, you have to zoom out.
You do, because if you rewind to July of 2025, this thing was trading way up at $70.43.
Which was a massive premium.
Right. And then from that peak, it just bled out. It dropped all the way down to a brutal low of $13.74.
That is a harsh reality check.
It's a 63% drop. I mean, honestly, it's like a bungee jumper who realized their cord might be a little too long, They plummeted, and now today they're violently snapping back up 11%.
Yeah, that snapback is intense.
So the question is today a dead cat bounce or the start of a massive recovery?
Well, price action on a single day is mostly just psychology. So if we want to know if that bounce is actually justified, we have to transition away from the stock chart and look at the actual business engine, the financials.
Right, let's look at the engine, because the top-line boom is kind of staggering. I'm looking at their fiscal year 2025 income statement highlights, and total revenue hit an impressive $2.35 billion.
It's huge.
Yeah. Up a massive 59% year over year. Net income is sitting at $128.4 million. Adjusted EBITDA is at $318 million.
It looks fantastic on paper.
It does. Over $2 billion in revenue, growing at near 60%. That's incredible.
It is, but if we connect this to the bigger picture, you start to see the cracks. You have to add some nuance here.
Okay, what am I missing?
The margins. Despite that massive revenue boom you just read off, their gross margins actually dropped. They went from 79% in 2024 down to 74% in 2025.
A 5% drop.
Exactly. Which means it is simply costing the company more money to deliver that new growth.
But let me push back on that for a second. Let's look at the balance sheet. They have roughly $2.15 billion in total assets against $1.61 billion in liabilities.
Right.
And they're generating $300 million in operating cash flow. $57.4 million in free cash flow.
Oh.
So if the business is generating over $2 billion in revenue, growing at 59%, and clearly cash flow positive, why on earth did the market punish it down to $13 a share earlier this year? That seems like a massive overreaction.
Well, because the stock market often trades on momentum and forward-looking risk, rather than purely looking backward at last year's fundamentals. Wall Street saw those shrinking margins and got spooked.
They extrapolated the fear.
Exactly. Which leads us perfectly into the technical analysis and the order flow we're seeing right now, because the technicals show a total trend tug of war.
Yeah, the timelines are completely conflicting.
Right. The stock is experiencing really strong short-term bullish momentum today, obviously, but it is still trapped in a very bearish, medium-term falling channel.
You can see that clear as day in the moving averages. Like, the stock closed at $26.99, which means it is currently trading above its 50-day moving average of $19.53.
That's a good first step for the bulls.
It is, but it's still suffocating below its 200-day moving average, which is looming way overhead at $32.70.
And until it breaks that, the big trend is still down.
Yeah, and the RSI is sitting at 52.16. That's totally neutral, maybe slightly bullish. The MACD is at negative 0.03, but it is rising.
But the real story in the technicals today isn't the averages, it's the volume.
Oh, the volume was insane.
Unbelievable. Volume peaked at roughly 80 million shares today.
80 million.
Yes. For context, their 10-day average is just 23 million.
So they obliterated their average volume.
Obliterated it. That is massive institutional buy-demand stepping in.
That's hedge funds.
Absolutely. And going forward, there are key levels you need to watch. Immediate resistance is right overhead at 27.50 to 27.81, but there's a strong safety net of support down in the $19 to $20 area.
But here's where it gets really interesting and honestly super mysterious. Yeah. We just said 80 million shares traded hands today, right? Big institutional money buying. But if you look at who has been holding the stock over the last few months, it's a shocking contradiction.
Let's hear it.
Over the last 6 months, there have been 23 insider sales. And zero, I mean absolutely zero insider purchases.
Zero buys. That is a massive red flag.
Right. And it's not just the executives. The smart money has been running for the exits too.
Yeah, major institutional players are bailing. Forerunner Ventures completely liquidated their position. Minus 100%.
Wow.
And Renaissance Technologies slashed their position nearly in half. Down 47%.
I mean, it's like being invited to this incredibly glamorous, massive party. The music is bumping, revenue is up 59%. But then you look around and notice that the hosts and all the VIPs are quietly slipping out the back door.
That is exactly what it feels like. And it sets the stage for the ultimate debate we have to have right now.
Is this a value trap or an undervalued gem?
Right. Let's look at the valuation. The PE ratio is currently sitting at a lofty 52.92.
That is a high multiple.
It is. Despite being down 53% from its peaks, many analysts still view it as a high multiple growth play, not a deep value stock.
So what are the analysts actually saying?
It's mixed. Bank of America raised their target to $25, but they kept a neutral rating. Leerink reiterated a $25 target with a market perform rating.
Basically a hold.
Yeah. Barclays is the outlier here. They raised their target to $29 with an overweight rating. So the general consensus is kind of a mixed buy or hold around $25.50.
Well, let me advocate for the bulls here for a second, because there is a strong case to be made.
Go for it.
HIMSS boasts 2.51 million steady subscribers. That is recurring, sticky revenue. And they are making this massive, aggressive transition toward branded and commercial GLP-1 weight loss products. They are targeting 100,000 prescriptions a month. If they hit that, the revenue potential is astronomical.
The potential is there, sure. But here is the bear counter thesis.
Okay.
HIMSS relies heavily on compounded medications for those weight loss drugs. They don't own the IP. And compounded drugs face intense regulatory scrutiny. The FDA only allows it because of current drug shortages.
Right. If the shortage ends, the loophole closes.
Exactly. Plus, they are fighting a literal war against massive pharmaceutical titans. Eli Lilly, Novo Nordisk.
The trillion-dollar giants.
Yes. And those titans are building their own direct-to-consumer pipelines now. They want to cut out middlemen like HIMSS entirely.
That is a terrifying risk for long-term holders. And honestly, this high-stakes tug-of-war between the fundamental bulls and the structural bears, this is exactly the kind of environment where everyday retail traders get chewed up.
Well, retail gets absolutely slaughtered in these setups.
Because it's a powder keg. Which brings us to the short interest. The short interest on HIMSS remains highly elevated at 45.18% of the float.
45% is staggering.
It's almost half the tradable shares.
Right. And that is exactly why this is so dangerous for retail traders. Let me explain how this extreme volatility actually works in practice.
Yeah, break down the trap.
So, retail investors are sitting at home, they see an 11% jump today, and they get extreme FOMO, fear of missing out.
Naturally.
So they buy in right at the top of that resistance line we mentioned earlier, right around 27.50. But with short interest that high, the institutional short sellers use that level to hammer the stock.
They just flood the market with sell orders.
Exactly. They defend that resistance line aggressively, driving the price back down into its bearish descending channel. And the retail buyers who bought the breakout, they're instantly trapped, holding the bag at a loss.
It is brutal. So having mapped out all of this, the financials, the technicals, the insider exits, and the short seller traps, we really need to give the listener a final roadmap.
We do. There are two distinct scenarios you need to be watching right now.
Right. The short term versus the long term.
Let's start short term. The short-term outlook is highly volatile with a positive bias right now. If, and it's a big if, the stock can actually clear that $27.81 resistance, we could see a best-case recovery scenario.
Fueled by a massive short squeeze.
Exactly. Those short sellers would have to cover, and the price would rocket. However, the worst-case scenario is a sharp rejection at that resistance level and a continuation lower toward that $19 support.
That's the short-term trading view. But medium and long-term success entirely depends on the company executing its GLP-1 weight loss strategy against Eli Lilly.
Without a doubt, execution is everything now.
And we are going to get a massive clue on that execution very soon. Mark your calendars for the ultimate proving ground. Q1 earnings are coming up on May 11th, 2026.
That earnings call is going to be explosive. Management's going to have to answer for those dropping margins and the insider selling.
They definitely will. All right, we've covered a lot of ground. Once again, if you enjoyed this deep dive, please like the video, subscribe, and hit the comments section. We want to hear from you.
Yeah, and honestly, all this fader raises an incredibly important question for anyone watching this.
It really does. With insiders actively bailing out while the company pushes for this massive weight loss market land grab, are you looking at a generational turnaround opportunity here, or just a 45% short interest powder keg waiting to blow up?
It's a tough call.
Let us know what you think in the comments.